All right, ladies and gentlemen, this is Aaron Fragnito, your host of the this new show we're going to do with real estate news, the weekly real estate briefing here, sponsored by People's Capital Group. We're going to talk about real estate updates, just some news headlines that are going on right now out there. And we're going to break into some interesting news stories here. Hopefully everyone can see my screen as we share our screen here. We're going to talk about some interesting headlines that we found recently. Real estate news. This is a show by property owners for property owners, and we're going to break right into it here. A very interesting article on the Real Deal. So here's an article I read this morning on the Real Deal. Biden's tax plan would pull out the rug out from under the real estate industry insiders. Okay, so here's an article about how the presumptive Democratic nominee is going after the 1031 exchanges. Now, read through this article briefly here. Joe Biden went after one of the real estate industry's favorite tax benefits Tuesday when he proposed funding a child and elderly care spending platform by closing off a loophole used by property investors. Okay, the presumptive Democratic presidential nominee proposed eliminating the 1031 like-kind exchange for investors with annual incomes greater than $400,000 as part of his plan to finance $775 billion in government spending over the next 10 years on child care and care for the elderly. So the 1031 tax exchange is, if you don't know, a tax rule that allows you to sell a building and trade into a similar like-kind building over a certain amount of time. You have a number of days and months to complete the transaction, but if done properly, you can defer all capital gains tax owed on the sale of your real estate. Now, the reason this law is in place is because when we buy a bigger building, when a real estate investor buys a bigger building, we buy apartment buildings in New Jersey here with People's Capital Group. So our plan for these buildings is to improve the cash flow with our in-house management company, make better cash flow for our investors and better tax returns and large refinance payouts as well, and build the value of the real estate over time, and essentially sell the building through a 1031 tax deference and trade into a bigger building. This allows us to buy a bigger building. This allows us to improve the economy by moving more capital, by improving more real estate. And the 1031 tax deference, if that's taken away, will be a real big curve to the real estate market, a huge challenge. So if you call yourself a real estate investor and you own real estate or you're looking to invest in real estate, you need to understand that unfortunately, it seems like the Democratic platform is looking to take away this 1031 exchange, which is not something that I agree with personally as a real estate investor and a capitalist in general. So here's continue to read the article here. The real estate industry experts noted efforts to eliminate the 1031 exchange has been made before. The reason the tax benefit still stands, they say, is because lawmakers recognize its positive impact on the economy. Right, so this really does create a positive impact on the economy by being able to trade into a bigger piece of real estate and not get nailed on that capital gains tax. It allows investors, it gives them that incentive to go buy another piece of real estate, because otherwise, you're just going to remain in the same building indefinitely as it cash flows and creates value. By having the 1031 tax deference, it keeps the market moving, it keeps investors trading into bigger buildings, and it gives them a reason also to continue to move that capital into a better building, continue to improve that market. Okay, if we're stuck with the same building indefinitely, then there's no reason for real estate investors to trade up. Continue the article here. They've talked about getting rid of the 1031 for years, so I'm not surprised it would be part of Biden's plan, said Stuart Saft, head of real estate department at law firm Holland & Knight. Whenever Congress looked at these things, it's been preserved. So he's saying, this has been on the minds, this has been on the talking points of politicians for years on the left, and it's not something so much to be worried about. It's something that generally Congress and Senate is able to vote down, but of course that's not guaranteed. Continued here, Saft stressed that eliminating the exchange at a time when the real estate industry is reeling from the coronavirus would be a major blow to the struggling economy. Right, real estate plays a huge role in our economy. The value of it, the trading of it is very, very important. Article goes on to say it would just pull the rug out from underneath a very huge part of the economy. So Biden said that his proposal would also limit investors' ability to offset their income tax from real estate losses. Okay, let's hit the brakes there for a second. Let me reread that sentence one more time, because I don't think this is getting enough notoriety. Biden said that his proposal would also limit investors' ability to offset their income tax bills from real estate losses, would add millions of shovel-ready jobs to the economy, particularly for women and minorities. I don't understand that. I'm not sure how you can remove a huge tax law here in real estate, change the game completely, take away the 1031, and then the next thing out of your mouth is we expect to improve the economy. That makes absolutely no sense. But in this case, the Biden administration is talking about not only removing a 1031 tax exchange law that helps real estate investors and incentivizes them to create more jobs by buying more real estate, selling the real estate, buying real estate. That creates so many jobs: contractors, brokers, banks, attorneys, title companies, all the people working on the real estate, moving the real estate. That is what creates the jobs, the movement of capital, the trading into bigger buildings. And if we can't write off our expenses, and the rules change for the exit strategy, which, by the way, we buy real estate with a 15-year plan. If that 1031 tax deference taken out, that's a problem. So we want to recognize that the rules are set a certain way. They need to stay a certain way for real estate to continue on a productive path here. And hopefully the administration sees the value of being able to write off your expenses and being able to utilize the 1031 tax deference. Although I have seen politicians really miss the mark on a lot of things recently. So continue the article here. The way we pay for it is by rolling back unproductive tax cuts. Some of the $2 trillion tax cuts this president put through. Okay, that's the small business tax cuts. That's a little less controversial. I mean, that was a new tax cut Trump put in place about 2 years ago. So this would simply reverse that. I don't think that would be too devastating to the real estate economy itself. He said during a speech in Delaware Tuesday, closing loopholes, unproductive tax cuts for high-income real estate investors while ensuring high-income earners pay their tax bills. So, again, the idea of kind of taxing the rich, if you're too successful, the government's going to come after you. I don't agree with this at all, but it looks like that's the plan here. Like-kind exchanges have been part of the U.S. Internal Revenue Code since 1921. They allow real estate investors to defer capital gains taxes when they sell properties by directing the proceeds into new investments, okay, usually within a few months after sale. Very interesting stuff here. But more than just deferring taxes, investors continually roll the gains into new properties, often in perpetuity, effectively eliminating those tax liabilities. So in real estate, unlike in stocks and securities, the article continues, where you pay tax on your trading gains, you can just keep rolling over. So people do this for decades and decades. I'm going to stop here for a second. And that's exactly what the idea is, to remain invested in real estate, to build that wealth over time, and to continue to buy bigger and better properties is not a problem. Okay. I don't want our government, I don't want our society to think that buying good, beautiful real estate, maintaining it well, trading up into better properties over time is a problem. Okay. That's something we work hard to create. That's something we work hard to gain advantage of in our business, in our economy, in my life as a human being. We want to keep improving ourselves, keep improving our business and our wealth. So it's a shame that, a lot of talking heads today look at building wealth as a problem. It's really not. Wealth is a great thing. Wealth allows us to make a positive impact on the world. Michael Packman, a wealth management advisor, the article continues here, describe the tactic as a swap till you drop. So in 2016, he estimated that the 1031 exchanges exceed 100 billion in property, nationally exceed 100 billion in property sales annually. So I'm not surprised that people who are trading stocks and bonds are not, are saying, yeah, let's get rid of this 1031 tax deference, because it's actually an unfair advantage compared to stocks or bonds. The argument can be made, well, if you can sell real estate and avoid capital gains tax, why can't you do it with a stock? The answer to that question, in my opinion, is because real estate really actually creates tangible jobs in a location. If you're selling stocks, absolutely, large investments in a publicly traded company give that company capital, but it doesn't necessarily have the exact tangible effects of buying an apartment building, hiring local contractors to renovate it, buying all those materials to put into the property, leasing out the unit, using local services to do all these things and run and manage and own the building day by day. That creates jobs, that creates income locally. Investing in stocks and bonds don't necessarily create direct jobs like that. So the government recognized this years ago, and they said, okay, then we're going to give that advantage, that tax advantage of the 1031 to real estate investors, because real estate really creates tangible jobs in a location, and the positive effects of buying real estate and improving it can be seen throughout cities. So we want to encourage that for people to do that, taking away this tax incentive, quite frankly, in the middle of, the game here where we're buying and selling real estate is not fair to us doing it, and something that really would have a negative impact on our real estate values and our economy in general. So if you're a real estate investor, you really want to think about what this law would have on our real estate. And I'm not surprised financial advisors advising people, saying, well, maybe we should get rid of it because it's not fair to stocks and bonds, right? So he continued the article here. The 1031s have been targeted before. Most recently, Republican House members had proposed eliminating the benefit in the lead up to the 2017 tax bill reform. I'm going to stop right there because Republicans are supposed to be pro-business. I guess we lost that here in the last few years. Continued here, which Donald Trump passed with benefit intact. Okay. Article continues, Trump is a prominent real estate investor, stands to benefit personally from 1031s. He's reportedly looking to sell his stake in a pair of office towers in Manhattan and San Francisco, properties he purchased after realizing a huge gain in 2005 on a Manhattan development site known as Lincoln Yards. I actually learned about that. Great investment for him. Great exit he's taking part in now. That's exactly where we want to be as real estate investors. You might not like him as a president, but as a real estate investor, he's absolutely crushing it. Continues here, yet despite efforts to eliminate 1031 exchanges, lobbyists for the real estate industry in Washington have been effective in preserving them. Good, I'm glad. Article continues, Jeffrey DeBauer, head of Washington, D.C.-based real estate roundtable industry group, said one key trait of 1031 exchanges is that they allow investors to own real estate with less debt. I'm going to stop there for a sec. So that's good, right? We want to trade into bigger buildings, keep our debt low, keep your risk low, keep foreclosures low. Article continues. As a result, exchanges allow cash-strapped minority, women, and veteran-owned businesses to grow their business by temporarily deferring taxes on the reinvested proceeds. He said, like-kind exchanges are particularly important during economic downturns when access to capital is less certain, right? It's getting hard to borrow from banks. DeBauer added the roundtable views congressional review of like-kind exchanges is reasonable and appropriate, and that the group will support sensible reforms. Francis Greenberger, head of Time Equity, said the 1031 exchanges are critical to the economic function of the real estate markets, and said effort to cut them come from a lack of understanding about their economic benefits. That's what I was just explaining. There's a huge benefit to the 1031 tax deference. Okay, I don't know why everyone thinks giving our money to the government is a better strategy than keeping it and investing in real estate and creating jobs, right? I don't understand why the strategy is, if you have extra revenue, you're doing really well, you should give that to the government because they know how to spend it better than you. I do not agree with that. Article finishes here. Somebody who's talking about eliminating these doesn't fully comprehend why this is a good thing. He said they're just looking at it superficially. Okay, so nice article here, really covers both sides of the story. Interesting look into where we could be headed if the Biden administration does get voted in. Here's another article. Rural real estate prices rise as people consider leaving cities. Subtopic, the virus is impacting how we spend money, how we shop, and perhaps even where we want to live. And here's a picture of a house in Bridgewater, Vermont. I'm going to stop here for a sec. Interesting thing, they show a picture of Bridgewater, beautiful colonial here, red barn color, and then the mountains with the foliage behind it. Vermont's a beautiful place. I actually own some real estate up there, and I lease them on Airbnb. My wife helps. It's a nice little income for us, and our investors actually get to go there for free to enjoy the Vermont outdoors. They're near Okemo Ski Resort, beautiful place, and actually very close to Bridgewater here, Bridgewater, Vermont. So, that's an interesting what's happening there. My Airbnbs are booked up for about twice what they usually go for, and for about the next 2 or 3 months. So if you are an investor with People's Capital Group, unfortunately, we can't get you in there anytime soon because the demand to lease these units is phenomenal, and the price for them has just skyrocketed recently. So People's Capital Group is actually breaking into the Vermont market and getting more Airbnb properties up there, and we're considering starting a fund to do that. But let's finish this article here. So the COVID-19 impact has already changed the way Americans live, but its long-term repercussions may be our world even after the virus is eventually controlled. A range of indicators looking at the Americans' economy decision-making shows the virus is impacting how we spend money, how we shop, and perhaps even where we want to live. Let me hit the brakes for a second. It was interesting. I was listening to a radio ad the other day, and it said, if you do this, you'll earn an extra $1,200 a month or something, selling some service or product. And they said, with that extra $1,200 a month, you can go on vacation. You can buy that car you wanted. You can spend it on, it was one more thing of spending it. And they didn't mention anything about like paying off debt or saving it or making more money with that money. I guess that's not fun. That's not going to encourage people to buy your product. But at the end of the day, we are so not educated to make money with our money. I wasn't taught it in college. I was not taught it in high school. I'm an entrepreneur major. I was taught what a franchise was. I was taught what a debit and credit was. I was not taught what wealth was. I was not taught why the 1% earns so much and the rest of us work so hard to get there. I had to actually read a book like Rich Dad, Poor Dad to understand that, and in turn developed a real estate investment company 10 years ago and hit the ground running. So it's very, very important. I'm a huge believer that we need to really change the educational system to teach what wealth is, how wealth is created, and that wealth is actually not a bad thing, and that it can allow you to really make a positive impact on the community. But we're going to continue here. Together, the data serve as a reminder of how consequential the coronavirus could be to the country's future, even beyond health concerns as the nation tries to get a handle on the growing number of hotspots in the country. The most common word associated with the virus through its rise and plateau and renewed rise may be uncertainty. And the mood is reflected in a shift in how Americans are spending. So here's a graph that shows the changing in how we spend. In 2009, in May of 2009, we spent more on credit cards. Now we're spending more on debit, which is good. We're borrowing less. We're using cash to buy products more. That is good. I personally am doing the same thing myself. In June, Visa reported that Americans' volume on spending on credit cards declined by 21%. It's a big number. In May of 2020 compared to May of 2019. That's a huge number. It really is. At the time, same time, their spending on debit cards climbed 12%. Okay, money's got to come from somewhere. And beyond personal bank accounts, that's a change that could have a big impact on the broader economy. It's always better if we all have more savings. Article continues, for individuals, it could actually be good news. Americans are notorious for running up credit card debt that could leave them in a lurch when the economy dips. With credit cards, they are only spending money they have and not future money they may or may not have. But for the nation, the overall GDP, the shift in spending habits news looks less sunny. When you only spend on what you have, you usually spend less. That likely means fewer dollars flowing into the economy when it needs growth. All right, let's stop there for a sec. So I do agree with that. I mean, the consumer spending is the engine behind our economy. I think it's 70% of our economy. So we need to be spending money. We need to be buying new dishwashers and getting that motorcycle you always wanted. But at the same time, we really should not be going into large amounts of debt for these things. You know, when I want to buy a toy like a dirt bike or an ATV or a motorcycle, I love my toys. I save cash. I try not to finance it. Unless there's like ridiculous options. And even then I'm going to put down a good amount of money and finance very little of it. So I really try, it's important to buy those products with cash. Those are toys, those are liabilities, those are things that we want to enjoy, but they don't hold any value really. They depreciate in value very quickly. So they don't make any profit. Okay. And because of that, they're liabilities. We want to make sure we're not necessarily putting those on credit cards, which is what a lot of American consumers do. It goes on to say, and that idea of being more careful with money can also be seen in how people are making decisions when they shop, according to a June survey from McKinsey & Company. So here we show a chart that says shoppers are more mindful. They're buying less expensive products and new brands, and are buying from new brands or retailers. Okay, so that's interesting. In that survey, 40% of Americans said they were becoming more mindful of where they spent money, and 31% said they were changing to less expensive products to save money. A remarkable 75% of those surveyed said they have tried a new shopping behavior, switching brands or retailers during the pandemic out of convenience, value, or availability. And maybe more importantly, more than 70% of those said they plan to stick to that behavior when the crisis is past. I don't know, if I was a betting man, I wouldn't bet on that. In other words, the COVID crisis is challenging and changing long-held consumer patterns. The shift happening during the pandemic are not only far-reaching, they potentially could endure long after vaccine or treatment is found. Good. We should use credit cards less. We should spend our cash more. Okay. Don't get into crazy high debt. Credit cards are bad debt. Continues here, and there is data that shows an even more enduring change could be coming. New attitudes about where people want to live. Data from Realtor.com suggests people are interested in moving, and there seems to be an increasing appeal to properties outside of cities. Right? Duh, of course, these cities are holding a lot of people in one place, and people are looking to move out to more rural areas. You always want to keep an eye on that. People are moving out of New York City to North Jersey. That's good for us. We own a lot of real estate in North Jersey, so we see the market is super hot right now. Here's a chart showing urban investment is from June 2019 to June 2020. It looks like suburban investments up 30%, rural up 34%, urban's up 19%. Okay, so rural and suburban are beating out urban. So that's an interesting shift. It was not like that a year ago. We're moving to cities. Okay, I think this is a shift, and I think it's actually kind of here to stay for some time. So we're looking at some rural opportunities. We're looking at real estate in Vermont right now. We're looking at real estate in more rural areas of New Jersey. And we also are focusing on our inner city areas here in New Jersey as well, where people move to get out of Manhattan. Okay. Article continues. The Realtor.com figures, which compared this June to June of 2019, found that homes in rural and suburban zip codes saw the biggest jump in average views per property. Homes in urban zip codes had a 19% increase in views compared to last year, but homes in suburban zip codes had a much larger 30% jump, and homes in rural zip codes saw a 34% increase in views. Property views are not property sales. Course, it's hard to imagine the nation's larger trend towards an urban migration is just going to suddenly stop. But these numbers show that there's at least an interest in getting out of the most densely packed areas and into communities that are more spread out, okay, suburbia and the rural areas. So New Jersey is actually really nicely placed for that. Anecdotal evidence suggests some of it may be about searching for second home getaways in more remote communities, right? That's what a lot of people are doing now, trying to get a second home to get away, get out of the city, go on vacation. Those kinds of locales hold some advantages in the time of COVID. Suburban and especially rural communities are places where social distancing is more of a built-in part of everyday life, away from crowded streets and mass transit. I hear that. And if working from home becomes a more common and accepted practice, I kind of think it is, even after the pandemic, long commutes may not seem like the negative they once did. There's a difference between being stuck in traffic 5 days a week and being stuck in traffic 3 days a week. I totally agree with that. That's what I have worked out here with my business partner. 3 days a week, baby. Of course, making predictions about the future during the pandemic is not easy. Just a few months ago, fall sports and schooling seemed like a pretty good bets. Now they're seeming increasingly unlikely. Uncertainty is the only real certainty. Boy, I can say that again. And that's always the case, by the way, people. But it's also impossible to ignore the larger impacts that COVID-19 is having on the nation. Impacts that go far beyond the healthcare system, even the unemployment rate. They suggest the virus has altered the way we think about money and the way we think about our daily lives. Good. And some of those changes may be with us long after the virus is gone. Nice article here on NBC and CNBC. So interesting story there. I think we need this shift in thinking. We need to think more about using money to make more money. That's how the wealthier get wealthier. And here's a story on Fox Business, Stuart Varney, in his latest My Take. See, I try to get an article from each spectrum here. Okay, Fox, NBC, and Real Deal, which is kind of moderate. So my goal is to get all sides of the story, because quite frankly, you put on a news channel today, you don't get all sides of the story. You get their side of the story. So here, Fox Business, Stuart Varney said in his latest My Take, argues that real estate has become an alternative to stocks as the market soars during the coronavirus pandemic. This is great for real estate investors. Remember the expression, Tina, there's no alternative, he said. That is no alternative to stocks. Well, there is an alternative. It's called real estate, specifically single-family homes. I don't agree with that, but we'll go on here. The single-family homes, I think, well, sure, that's not a bad investment, but actually residential apartment buildings are really better for cash flow. Anyway, according to Varney, home prices and mortgage applications are on the rise, and realtors have reported a surge in open house foot traffic. All right, so he's talking about owning a home and building wealth that way, which is great. You need to own a home. You need to build your wealth. Renting just means you're paying your landlord's mortgage down. You should own a home if you're a real estate investor. I know there's different schools of thought, but I'm a fan of owning home. I also like owning a home. It's fun. Market watcher Mark Temper told Varney that home buyers in Cleveland are paying above the asking price for some locations. Cleveland, that's great. Cleveland got hit so hard. Thank goodness. Cleveland, I love Cleveland. And starting bidding wars. Okay, let's continue here. Let's not get carried away here, he said. It's not yet the return of the golden years of 2005 and 2006, but it's true to say that the good times are coming back for realtors, and that's an invitation to take some money out of the stock profits and put it into a second home. Hallelujah. A vacation home or just a bigger home. Okay. I'm going to stop there for a sec. I don't really agree with just having a second home and going there a few weeks here and there. Try renting it out on Airbnb. Try buying a property that maybe has a back unit that can create some income. Okay, real estate should be used to make money, not just plop your cash down and hope the values grow. I'm going to continue here. Varney said that is technically considered asset relocation, moving money from one type of investment to another. Demand for real estate is being driven by the coronavirus pandemic, the need for people to escape large cities and for the suburbs, and historically low mortgage rates, Varney said. I love that. Rates are so low. I love where rates are right now. So here it goes. There's a lot of people who want out of the cities because they're crammed in with children trying to work from home. No kids yet here. They want space. The suburbs and rural areas look good. I agree. Election risk is also pushing stock investors to relocate their money, Varney said, as a Biden win and mail-in balloting is a threat to stock prices. It's going to definitely bring the economy down if Biden gets in. Trump is far more pro-business. He goes on to say, why not reduce that risk by switching out to real estate? He said, there's no immediate election risk in a better home, unless the 1031 is removed, and you can't write off your real estate expenses, but that's a different article. Goes on to say, of course, we have mentioned the great tax exodus, which is going strong and pushing people out of high tax states into Florida, Texas, Nevada, and Tennessee. Added up, maybe Tina has had its day. There's an alternative to stocks. It's real estate. Okay, thank you, Fox. Thank you, Mr. Barney. Excellent article here. Definitely agree with it. I definitely like what they're saying. And I think that what we've noticed here from these three articles, so the first was saying that the Biden administration is reviewing taking away your 1031 tax deference and taking away some of the tax depreciation and tax write-offs that we receive as real estate investors. And the argument is it's not fair, right? Other asset classes don't get the 1031 tax deference like real estate does. And that's because, in my opinion, real estate really creates local tangible jobs where investing in a stock or a bond may not do that unless you're investing like millions and millions of dollars and allowing the stock to flourish. But if you're investing a small amount of capital, really buying a little bit of Ford stock, Ford's not going to go out. If I buy $50,000 worth of Ford stock today, they're not going to go out and hire more workers. That's not really how it works. But if I use that $50,000 to buy a property, get a loan, hire contractors to renovate it, hire realtors to sell it or whatever it is, lease it out, buy furniture to furnish it and rent it out, then that's spending money on the economy locally, creating jobs locally. And because of that, there's a tax incentive to buy and own real estate. It's called the 1031 tax deference. So I wanted to cover that article today. It's hugely important. Listen, whether you lean left or lean right, whatever your politics are, if you are a real estate investor, you have to recognize that the 1031 tax deference cannot be removed. And tax depreciation and the expenses of operating real estate cannot be removed either. If it is, that's going to really, really harm our real estate values and our real estate strategies in the commercial space. So I want to get that message out there. That's how I feel. If you don't agree, please write in the comments. Please contact us to learn more. We're People's Capital Group here. I'm Aaron Fregnito with People's Capital Group. And we have a podcast called the Passive Cash Flow Podcast. We have guests on that podcast as well that we talk about how to create passive income through real estate and general real estate and entrepreneurial and business topics in general. This message is going to be put out, this show here is going to be put out every Wednesday at noon Eastern time here. And we're going to go over news articles related to real estate. This show is by real estate investors for real estate investors. Okay, People's Capital Group here. We own about a $10 million portfolio in New Jersey. We have our management company in-house, and we help people passively invest in real estate, reap all the benefits of owning real estate like cash flow, wealth growth, and tax depreciation without having to do the heavy lifting and work behind the scenes. So if you want to learn more about that, our website is peoplescapitalgroup.com. But keep on listening in. If you don't agree with me, if you do agree with me, let's get in touch. Write some comments out there. Hopefully you are able to learn something. Hopefully we're able to understand more about the real estate industry through this explanation here. It looks like investors and capital and home buyers are going more rural. It looks like we're spending less on credit cards and more on real estate. That's great. And also, it looks like a lot of stock investors and talking heads in the financial community, like Varney here, are saying, "Hey, look at real estate. Real estate's a safe, age-old asset class." And I've been saying that for years, but hey, who listens to me? So that's it for today, guys. I'm Aaron Fragnino of People's Capital Group. Hope you enjoyed our message. Hope you enjoyed our little news briefing here. I'm going to close out for today. I'll see you next Wednesday, 12 p.m. Eastern Time, where we're going to have our weekly real estate briefing hosted by People's Capital Group. Enjoy your day.